Hi, welcome to another CIO series with me as the CIO of Private Wealth Management. With me on the call today, also Eugene Ng from Singapore, my colleague in research, as well as Garrick Lee, also here in Hong Kong with me. Before we start, a quick advertisement for a Chinese version of the CIO series, our first time of doing this in Mandarin Chinese. That will be next Thursday, September the 25th, also at 6:30. You need to register with the Microsoft Teams links here. If you're not sure how to do so, please email education@uobkhian.com.hk. And this time we will have an external host, independent research firm, TS Insight, to interview me about the global investment strategy post the Fed rate cut. And before the main content, also a quick recap of our China view. We've been saying that the new normal persists in China. Unfortunately, that is still the case, that you have continuing macro risk and policy disappointment, basically nothing 2 months after the third plenum in China still. But we are seeing some short-term turning points. One of them being the Fed rate cut this morning. I've been telling you about this in the weekly on Monday. I reiterated on Tuesday, all before today's Hong Kong market rally. And this is the way we do things. We tell you beforehand, not after, like everybody else. So the point is that the short-term positive that the Fed is cutting rate and 50 basis points even beyond my expectation, this will give China also more room to cut rates. And the other thing is also, we wonder if this deteriorating macro data would allow China or force China to do a bigger stimulus. That we do not know, but we're more conviction on more monetary policy coming. Could be as soon as this weekend. Mark my words, as soon as this weekend, PBOC is going to cut rates, and today's market performance already reflect that. 2 sectors to avoid, real estate developers and the banks. You can read my report on why, and 6 stock picks. 5 of them are our core recommendations, all on consumption. Okay, on the Fed rate cut, a few things caught my eye today. Number one, the stock market intraday had a big reversal. US bond market had a big reversal. Gold has a reversal. What the hell is going on? Most people will tell you, technically speaking, the market is pricing too much of the cut or whatever. But 50 basis cut, it's beyond people's expectations still. So my explanation, US stock investors are worried about recession. And I've been saying this since August the 2nd. So see, part of my job is to highlight also what are the key dates. Today is also a key date, reconfirming my belief that US recession risk is probably the biggest risk for the US stocks. Also because the Fed not only cut rates today, they also lowered the US GDP forecast. For details, you can refer to their website or you can email me for details. So that's not good. Bond investors, they're not so worried about the recession, otherwise the bond yield should go down. But now there's talk or maybe speculation that the Fed cannot control inflation. That's why you have bond yields 2-year and 10-year both up 10 basis points off the low. That is also very strange. You have stock price go down, bond yields go up at the same time. And gold also, that ideally they should be going up continuously, but had an intraday pullback. I think has to do with how much overbought it is. It's done very well. I've been recommending gold since December. If you listen to us, you would make 25% year to date. And that is a crowded trade now. So of course, some short-term technical correction. We still like gold very much long-term. Please do not sell everything. China I already talked about. So conclusion on the US is nothing wrong. Again, let me say, nothing wrong with taking some money off the table, taking some risk off the table. Absolutely nothing wrong with that. It's time to sit down, observe the market, learn how the market react to the Fed cut. So today's opening in the US is very important. And then we do another round of attack again. And that's kind of from one of my friends, is the Germans' tactic in World War II: observe, learn, and attack. Now, taking profit does not mean you sell everything. I said this many times to all of you. Stay invested, please. Convince your clients to stay invested. Trade, but stay invested. Where do you stay invested? Our core recommendation at the end of this presentation, you can also find it in our Wealth Monthly. So these are the stocks you need to hold on to. You can trade it, but hold on to. And understand that it's common for the market to feel nervous about the economy when the Fed first cut rate. But look forward longer, give it enough time. The US market often delivers positive, in some cases, very good returns 12 months after the first rate cut. And there's reasons for that. I can explain, but let's just save it for Q&A if you like. Our main content today is how to play defense. This is also very timely. You do have China market go up, but the US market looks a little bit shaky. Let me say that again. The US market looks a little bit shaky. And there's nothing wrong with take money off the table, but don't be so bold and remove everything. That is the stupidest mistake you can make. Stay invested, control your risk, play defense. And we also said this before, you need both. You need your Nvidia to give you the high risk, high return. The game changer of the world. You also need the stable companies, the defensive plays, right? So if you've been following our research, we call this the barbell strategy. And our best barbell strategy pick, actually the only barbell strategy pick in the US is Walmart. We got very lucky on that. It's up 52% year to date versus the S&P is up only 19%. So both did very well this year. Nvidia up more than 100%. Our defensive play up 52%. And only recently the market caught up to us. And note the date about Walmart is now taking over from Nvidia, September 16th. When do we tell this to buy Walmart? December 2023. Again, please do not underestimate the quality of research. You can say we are lucky, but today let me show you why we are not lucky, because this is supported by research. So what is a true defensive play? If you ask 100%, they're going to give you 100 different definitions. The textbook definition, there's Chinese definition, there's the Japanese and the US, whatever. So some people say, well, it's a sector approach. 3 sectors come to mind when it comes to defensive plays. Healthcare, that's the upper left corner. Utilities, food and staples. Is that right? Not really. Okay, I'll explain why. High dividend yield, is that give you enough of a cushioning? Safety? No. In fact, the high dividend yield paying stocks in the US is the worst performing stock so far year today. It's not about high dividend yield. Walmart is not high dividend yield. Low PE, no. You could have something like Costco. It was already at something like 40 times PE at the beginning of the year, and it's still more expensive today. But that's a defensive play in our view, a good defensive play. So here I have a stock, US stock, that the opposite case, you have low PE, low price to earning ratio, low valuation, but you have continued low valuation, and the stock price, it just continue to go down. We call that a value trap. Yes, it's a value trap in the US. You can not only have value trap in Japan, this is a classic value trap in the US. It's a big cap stock. I'll tell you later what stock this is. Now, is low volatility the way to go? Is that defensive? Low volatility usually associated with low risk, right? No, because you could have a low volatility stock that continue to go down. This is a Hong Kong stock, Hong Kong utility stock, has very low volatility in Hong Kong's case, but performed much worse than rest of the market. In Chinese, we call that 阴跌啦，阴跌就阴天的阴，跌下来的跌。So you have lots of these stocks in A shares in Hong Kong where it looks like a low risk, but it goes down every day, and it goes down to small bits pieces, and over 1 year you lose a lot of money, even though you don't see it in the volatility. Okay, so what is a true defensive play? Who do you think about when you want to play defense, want to play safe? Warren Buffett. I don't think there's a better person than that. So even he confirmed that his style of investing is not about low PE. It's not about low valuation. It's not even about high dividend yield. I barely hear him talk about dividend yield, but he does talk about two things obsessively. The first is a very corny word called moat. You can see the picture here what the moat is. It's a defense against attackers in a castle. And he talks a lot about returns on investments, a lot. He may use a different word, return on invest capital, ROIC, or just simply return on capital. But it's the same, roughly the same concept. And some people say that is one of his favorite measures of stock selection. And before we go on, let me just also clarify that when we say defensive, it's not about 100% immunity. Later, I will show you. Even Walmart will go down in a 2008 financial crisis, right? Even Warren Buffett will lose money when the market's down or when you have a major crisis coming. So it's not really about absolute return and absolute safety. There's no such thing as absolute safety. But what you want is resilience. And let me demonstrate to you that in a second. Defensive is resilience. They can take a lot of hits and take a lot of damage, a lot of macro risk, and they can still navigate the things in their businesses. Return on invested capital, in case you want to know, it's a very professional kind of concept, and it's a measure of what the company really is, what kind of businesses this is. To me, that's one measure. I want to stress on one because there are different measures on what a company is. But this is probably one of the most important ones to me, to Warren Buffett, to people wanting to pick the defensive stocks and high quality companies. Think about this as if you buy a house, the money flow to you and the bank after paying taxes. That's what the NOPAT is, the net operating profit after tax. You buy a house, you need accounting what the bank is getting because the bank also has a stake in this if you have a loan. If you don't have a loan, that's everything to you. So in terms of return on invested capital, is really about the rental income to both the bank and you divided by the purchase price, not the market price, how much you pay for the house. Well, you can say that's kind of the rental yield, the net rental yield. When you buy a house will reflect whether this is a good house to buy, good house to invest, or the bad house to invest. So applying that ROIC concept, a very complicated concept, we did some lookup in the US market. We start with the top 100 US names by market cap, take out the financials. We get screen on a 3-year average ROIC of 10%. We need to set a minimum hurdle. We don't want to have a business that is very low ROIC. And then the next thing is very special, which is almost, I've been in the business for 27 years. This is my first time of trying this, and this is also a proven, you can see a proven screen that we screen on the volatility of the ROIC, the volatility, not the volatility of the price, not the volatility of the earnings, it's the volatility of what I just described, ROIC. It's a 20-year volatility, must be below 10%. We got 19 companies out of that 100. And these are the 19 companies that fit our criteria. I will share this PTT with you along with the replay. So if you miss it, don't worry, you will get this in writing. This is just the first step. And you can also see there's some technology companies there. And the next thing we did with China, very similar screening. Out of the 300 or so HSCI names, we got 20 or so names. Here for the ROIC, we set a little bit lower, about 8%. because Chinese companies usually have low quality than US, so don't expect them to be at par with the US here. Also, some very interesting companies pop up, mostly consumer energy, but you also have healthcare, materials, utility, etc. That's what I just said. Some people will define them as defensive. They will pop up in the screen. Okay, so a lot of information so far. I hope I explained clearly our framework based on the volatility of the ROIC. When you want a defensive name, the first thing you want to think about is how stable, how steady their return on invested capital is, how stable and steady the rental yield on a house is, right? You don't want to invest in something that, it's a very high yield, and then the next year it dropped to zero because you cannot rent it out. Same concept. You want a steady, stable ROIC. And based on that, you still need to do stock selection. Investing is never really about some quantitative screen, and then you can blindly invest in these stocks and you're done. So we still got 40 stocks, 19 from the US and 21 from Hong Kong, China. We need to pick. And that's where the fundamental research come in. And I briefly go through some of the criteria of what we look for. For example, you want to be in an industry that is not like a day-to-day change or month-to-month or year-to-year. You want the industry to be as boring as possible. Think about what Warren Buffett will invest in. He invests in pretty boring companies for a reason, right? So remember, in the US screen, there are some Google and Amazon pop up, some in technology companies, Adobe pop up. I don't really believe they're true defensive companies because these companies could be just changing one day or just overnight or sometimes over 3-year period, which is not that long. And they all have these technology changes that will change the business, sometimes good, sometimes bad. So we don't want that. So you want McDonald's, which is selling burgers. They're going to sell burgers today and then sell burgers in 20 years later. Okay. The competition is also very important, but I see almost all industries are very competition. So going back to the moat, think about the moat. What is really something the company has that can defend themselves? And dividends, I'd said dividend is not the most important thing, but we do need some dividends, okay? We don't need high dividends, but we do need to see the management is trying to pay dividends at least, okay, as much as they can. And the financial leverage is important. All of this really is about, the fundamental research is really about how sustainable is this return on invested capital. I talk about we need a hurdle for the invested capital. We need a stable return on invested capital. But we also need to prove fundamentally this is sustainable. That is the key fundamental research angle. And valuation is a plug to me. You should not start with valuation. We made the mistake of caring too much about valuation and did not pick Costco versus Walmart. We could have bought both and still do very well. So you can kind of see the valuation should not be the number one concern, because valuation is a plug. It's the final point whether decide you want to buy or not, how much you buy, and it's a moving target. It changes every day, right, with the price. Okay, so based on framework, let's talk about what is not a good example. So Nike, by the way, just to remind you, it does pass. If you read down from row 3, Nike passed our quantitative test for defensive, steady ROIC plays, right? But stock-wise, it's quite the opposite. It's probably one of the worst performing stocks in the S&P 500. So what Nike's problem was that, going back to the fundamentals, they destroyed their own moat. Eugene, if you're there, if you can talk quickly about what mistake they made based on our research. Can we unmute Eugene? Okay, Eugene, you're muted by yourself. Unmute yourself. Okay. Well, if Eugene cannot join, let me just talk through quickly. One of the key mistakes we made is about they're removing the so-called categories. And there was a really good article on LinkedIn the ex marketing head of Nike talked about this after he left the company. So remember, Nike have different categories for sports: running shoes, soccer, basketball, volleyball, CrossFit, and that was a really successful strategy because it's a key moat. I don't think anybody else that does that well, that entrenched into these different categories, led by different people who are very knowledgeable about these different sports, are able to develop innovative products for each specific categories ahead of everybody else. That is Nike. That was old Nike. And they got rid of it somewhere around 2020, 2021. They found out it was a mistake, and they got it back into this in December 2023, something called Fields of Play, which I think is too late. So I don't know how long it would take them to repair the 3-year damage they done to their own moat, right? Remember, talk about they had a moat, they just killed it themselves. So for that reason, we don't think Nike is a true defensive play right now. It was until they make a strategic mistake by the management. That's what I say. Back to our framework. If you look at framework, the corporate governance and management quality is extremely important. Okay, Costco. Everybody knows this already. We're not going to talk too much about it. The story is very well known. I just want to show you that our model is correct. The stock has done so well because it has really stable and steady and rising ROICs. I've never seen a ROIC chart that is that predictable and that stable. So I think a lot of the premium, a lot of the reasons the market likes it is because they like to see these type of companies in this environment. And you can see there's a strong correlation with the steadiness of the ROIC versus their stock price. Can Eugene speak? Oh, no. Okay, so Costco, everybody knows. Let's talk about something that maybe you haven't heard of, or maybe you have heard of, but you don't know the story as well, is TJX. They own a number of brands called TJ Maxx, the Marshalls, and others. And their model is very simple. It's off-price, deeply discounted retailer. In this market, they're so successful that they have 70% market share. And then they have some unique stories about it. Eugene, can you explain what treasure hunt is and what is a retail arbitrage on TJ Maxx?
Yeah, hi. Can you hear me?
Yep.
Okay. Yeah, so for TJ Maxx, what a treasure hunt experience is basically they are trying to get customers to have the excitement of a flea market, except that the brands there are top names and the merchandise is new, and you never know what is in the store. So because they are buying from all sorts of various full price retailers, there may be some branded goods in certain stores. So basically, customers will go there to look for certain like value buys to see what they can find. So that's a treasure hunt feeling for the customers.
Interesting. So when I heard the story, Eugene, by the way, they're turning the shopping into a game, which remind me of PDD, Pinduoduo in the early days, right? So this Pinduoduo also was founded by a bunch of gamers and turned the Pinduoduo, the what do you call it, 什么砍一刀啊这种东西, right, into a game. So I thought it was very similar, but of course TJ Maxx is a much longer history. When did they start it? 1970s?
80s. They have a 37-year history. Yeah.
Okay, great. And the retail arbitrage you told me is also very interesting. What is that?
So there are some customers who actually find the prices so cheap at TJX that they'll go there and buy and then resell the goods online. So on YouTube, you can see some of these videos with people going there to look to arbitrage. That's
right. There's a picture here says sell the mugs you get from TJ Maxx and you can sell them on Amazon to make a lot of money. Okay, given we're running short on time, let me run through the framework really quick. Remember the framework I talked about earlier, how to pick stocks, right? So you want an industry with low degrees of change, which is the case. The bad news is very competitive. Retail, don't get me wrong, it's very competitive. But Clearly, this company, by its sales strategy, pricing strategy, marketing strategy, and their experience of dealing with this off price and excess inventories from the brands and vendors is a mode that it's really hard to replicate, because they've been doing this for a long time and they have all the relationship in place. Part of the reason they are able to pass on, give the discounts, is because they're able to negotiate and take these excess inventory off the hands of somebody else. So that's their moat. And everything else check out, including the leverage. I want to talk a little bit about here. So remember what I said, defensive doesn't mean 100% immune. So if you look to the left of COVID, it was truly defensive. You have a very stable and very high, right? If you look at the ROIC, the return on invested capital, there's almost no change. And then boom, you had COVID hit. And of course, for retailers, that's almost like an end of the world when people stop traveling, stop moving, start spending money for some time, and you have a very sharp drop. Like I said, it's not about absolute. I mean, it's not about always steady and no change. You're going to run into a COVID. You may run into another risk. I don't know, like World War III, right? And of course, no one is immune to that risk, but we need to pay attention to what they have done and how quickly they recovered. That is the resilience. Remember when I say the word resilience? That is resilience. For true defensive company, they're able to jump back really quickly. And mind you, not every industry, not every company, especially in China, are able to jump back after COVID, including US, okay? So it also, please do not take this lightly. For a company to do this, you have a large drop in ROIC for whatever reason, and suddenly you're able to turn this around because you're really doing something special with the business, and you know the business quite well. Some valuation comps, we'll get to it if you like. What you can clearly see is that a company like TJ Maxx is not that expensive, okay, compared to Costco, but it is, I would say, slightly on the expensive side if you compare to S&P 500. S&P 500 earnings is only around, average is only around 19, currently trading at 21. TJX is trading at 28, right? So what does it tell you? Is that the market is willing to pay a premium for this type of companies. So this is the defensive names we just screened versus S&P 500 valuation premium over time. Clearly, you can see, you know, even though the premium varies over time, but the premium continue to exist. Even in China, when you talk about defensive names, these steady return on invested capital names, you have a sizable and consistent continuing valuation premium. So why the market suddenly like these type of names? Maybe, you know, not just the last 3 years, 5 years too. We have massive outperformance by Berkshire Hathaway, Walmart, Costco, and Nike at one point, Starbucks at one point. But of course, these two are not truly resilient, and we can go through reason if you like. But the truly ones, the resilient company, they did very well. So we also did some thinking and some analysis on this, because this is very important. This will decide whether we can still invest in these companies. If we do not understand the valuation premium, I cannot be comfortable owning these names. So one thing is changing last few years, as you know, is we have lots of big disruptions from geopolitical risk, whether it's Russia, Ukraine, or Israel, Palestine, or China, Taiwan. Plus, we have this thing called AI that is basically changing everything. So Anthony Blinken said this to China, that if you're not at the table, you're on the menu. I think all the AI companies are going to say that to the non-AI companies. If you do not jump on an AI bandwagon, you'll be eaten alive by people who can really leverage, by companies can really leverage AI. So in that context, there's a lot of change. But Jensen Huang also said, yeah, AI is great. It's going to cause another industrial revolution. But the two industries I don't think are going to change, being food and energy. And that also kind of get people interested in thinking about what is food and energy, what is so stable about it, and whether they can match it up with the AI stocks. Well, on the one hand, like I said, this is exactly a barbell approach. On the one hand, you have the AI innovation stocks. On the other hand, you have the stocks that are really difficult to change with AI. You want that because in a way that's also a hedging, that in case the AI thing slows down or AI thing does not plays out as expected, you still have part of your basket that is not unrelated, uncorrelated with AI. Okay, that kind of makes sense. So the world's becoming more uncertain, and then there's a scarcity value. You guys remember we squeezed 300 Chinese companies in Hong Kong. We got only 21 names, and we're going to select further from there. We screened 100 US names. We got only 19 names out of the 100. So these companies are hard to come by. Okay, a company like Walmart or Costco, it doesn't come every day because of the environment. Because we have uncertain interest rates, company can over leverage, and that cause the default risk and credit risk. So that's also an attribute that people like about these defensive plays. They generally tend to have low leverage than high leverage, right? Not like the banks, which is very highly leveraged. And then lastly, if you want to talk about specifically what are the risk factors, is the inflation. Even though inflation is it's for sure coming down, but there's still a lot of uncertainty on that. So think about which companies, which sectors are the masters of managing inflation. The first company I think about is Walmart. Maybe you have better ideas. Maybe McDonald's, maybe Coca-Cola. These are all masters of managing inflation. Their business is all about pricing strategy, pricing power, product mix. How do you navigate the inflation environment? And guess what? Generally, these companies come out better off than any other companies in an inflation cycle, whether inflation goes up and down. They're very stable. They tend to run very smoothly, regardless of how the inflation goes. So that's another reason the market likes them when you see inflation face so much uncertainty. Last slide and last very important question is, will this valuation premium? That pertains to the question of, okay, these things are great. Wang Qi, we like what you heard, but no, Walmart's 30 times, 35 times price to earnings. TJ Maxx is 28 times price to earnings. Costco's over 40 times price to earnings. So can we assume this, this valuation premium will exist, right? That's the key question. And this is the exact question that Bloomberg asked recently. Of course, Bloomberg has done no fundamental research. They just done some data mining to show you, well, these Procter & Gamble's or Costco, Walmart, they are getting very expensive, blah, 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 and you got to be cautious. Blah. But let's take a long-term view here. The valuation premium is not sustainable. If you believe the world will become more stable, more peaceful, and more predictable, these companies will offer no value to you. If the world getting very boring, you don't want to own another boring stock, right? What's the point? You might as well buy bonds. But we seem to think, we have a crazy thought that the world's becoming increasingly uncertain. So if you agree with us, if you are with me, you should seriously consider these type of companies. Remember, in an uncertain world, you need to own boring companies and boring businesses. When the macro environment, whether it's inflation, interest rate, or growth, becomes so uncertain. And I'm hope not crazy by saying that. So that is the reason you need to seriously listen to us, look at what the work we've done, look at the stock list. You can make your own choice to think which one's the true resilient company. You don't have to follow our framework, but we laid the foundation for you earlier, right? And again, remind you, it's not about 100% immunity. You buy a company, a great company, you buy it, hold it, but if the cycle goes the wrong way, they could miss execute or have some hiccups. But count on them to come back quickly. That's the attributes of the U.S. companies, some of the high-quality U.S. companies. My view that long-term, we still like these companies. I already laid out a case why in certain world you want to own these type of defensive plays. However, I do agree with Bloomberg's assessment that the valuation is a bit stretched in the near term. But as a core holding, I think, I just said earlier, keep investing, keep your position, keep the position. You can trade around it. If you think Walmart too expensive, you can trade some position. If you think Costco is too expensive, you don't have to buy now. We can wait. But hopefully we can get this at a good price. I will let you guys know, and then invest for the long term. Okay, I'm going to stop here and take any questions. Thank you so much. Thanks, Eugene, for the input as well. If you have a question, please use the window below to ask. Okay, great question from one of our listeners is, why do we exclude financials in the screening? That's a really good question. So let's go back to the screening. I think there are lots of financials that fit the criteria. For me, financial is both a quantitative concern as well as fundamental concern. So the quantitative concern is this: when you have the debt to equity, I don't think any financial company can meet the last criteria on this list, which is you want to have a reasonable leverage. And let me talk about leverage for now. This is relevant not just to financials, maybe other companies. So financial is too highly leveraged. And in an uncertain interest rate environment going forward, right? So again, everybody today think, well, if the Fed cut basis points, they're going to cut forever. No, this thing is going to be very volatile. Remember, we have 6 rate cuts in the beginning of the year. Now we have only 1 rate cut by September, right? So interest rate may very well be unpredictable. If you are a highly leveraged company, when interest rate go down, it's good for you. But when interest go up, it's going to be disaster. So we're not willing to take the interest rate risk. We want a company, ideally net cash, okay? And if not, have a reasonable amount of debt. And I don't want to name names, but there are some stocks here. Not here. There are some other stocks, like McDonald's. Actually, we think it's over leveraged. McDonald's is not a bank, but it's still over leveraged in our mind. They have all the rights to borrow, and the banks would love to lend to them because their business is so stable. But that's no excuse to take on more leverage. I think a lot of these companies take on leverage because they want to the ROE look better. That's why we use ROIC, because that will screen out the leverage factor first. We don't want to get into a situation the company just cooking up the ROE, right, by leverage. That's another reason. Okay, I'm deviating, but back to your earlier question. Leverage-wise, is not going to pass the test. Fundamentally, I said this before many times, that we just don't like the intransparency of global banks and global financials. That's not just the Chinese banks. I'm talking about all the banks almost in the world have that issue. And fundamentally, it's not going to work with us. Since I joined as CIO, you see that I barely talk about banks. It's because I'm really bearish on the banks. I don't think the bearish in the sense, not necessarily the banks will go down, but the risk you take by investing in the bank is not justified by the return. You're going to take high risk for a medium return. So if you want to take high risk, might as well go buy Nvidia. They will give you a much better return. Okay, hopefully I explained myself clearly here. If you have more questions, please use the window there's a question window to type out the questions, and we answer them in the order to come. So the next question is about a Fed pivot to the rate cut. They don't warrant a different playbook going forward as a screen. 3-year ROIC is a high interest rate environment and will be the result different in low interest rate. Yes, it will change a little bit. But if you think, but we tend to use the average. I think what we use here is the average 4%, which is not a low hurdle already. So you could say the 10-year could go to 8%, right? I don't know, like it could go all over the place, but 4% is still a reasonable forecast, as well as equity risk premium. So we get the 10% hurdle from 4%, kind of the 20-year plus the equity risk premium. In fact, both will change as the Fed cut or raise rates. Both will change, but over time, because we're investing for, let's say, the next 10 years or longer. Over time, I think we're in the ballpark. I think 10%, another reason we use 10% is Warren Buffett used 10%, regardless of the economic environment. So he often quotes that he needs a business at least 10%, ideally 20%. You know, he's very greedy in that sense. You want to even higher than that. But we in this case, we focus on the stability, so we're willing to take a lower rate, and even lower rate, don't forget, compounded is very powerful. 10%, even 10% compounding, it's a very powerful number over 10 years. Okay, 3-year high interest rate, yes. Hopefully answer that question. Yes, one listener wanted to know whether we have done this for other emerging markets. We have not. Just to appreciate the work we've done. We have done cross-sectional 100 companies over 20 years. That's 200 data points. That's very data intensive. 200 data points just for ROIC. We also check other things. So, so we will move on to the next step for other markets. The good thing is also some of the stocks already are in our core recommendation. As in China, we have China Mobile and China Resources Beer. So this exercise also helps us confirm that we are on the right track. Okay, Walmart's been getting lots of cheap goods from China to maintain margin, but US is increasing tariff on Chinese goods. Do you think Walmart will face margin squeeze going forward? Yes and no. So this goes back to the everyday low price strategy, right? So there's a lot of academic work and research work on this. Why not other companies? I mean, there are a lot of competitors in the space. Everybody want a low price. Why Walmart does so well? But let me answer the first question first. Yes, there will be inflation pressure for sure. Just if generally speaking, I think there will be inflation pressure if more tariffs are added. Biden just added another round of tariffs. We now have over, I think, close to $500 billion of Chinese goods are facing tariffs under either Biden or Trump administration. And when Trump becomes president, if he becomes president, I think there could be more coming. So this is a key risk to the Chinese economy, also key risk to U.S. inflation. There are various studies, including by one of the regional feds, on whether these tariffs can be passed on to the U.S. consumer. And the outcome is mixed. In some cases, they can, depending on the products. Interestingly, on clothing and apparel, they can. But on electronics, they cannot. Because electronics, by definition, is deflationary. The price will go down every year. So they do give you that room in terms of the tariffs to kind of maintain the margin or whatever, or the pricing. So it's mixed so far. So generally speaking, whether we can pass the China can pass the tariff onto the U.S. consumer, it's questionable. But let's assume that's the case. Walmart's everyday low pricing strategy is something that can enable Walmart to maintain a margin. Eugene, do you have the key points of that? I think there are 4 key points on Walmart's success with everyday low price. I think one of the points is about how they're really good with dealing with the suppliers and get the best pricing for the suppliers through volume discounts. And they're also really good at changing the product mix. Hello, Eugene?
Yeah. So a few points of the strategy is increased volume of sales and direct sourcing.
Yeah.
So it allows them to bypass traditional middlemen and negotiate lower prices from manufacturers.
Yeah.
And a couple of other points from the strategy is they have private label alternatives. So it has its own private labels like Great Value, Sam's Choice, and Equate, which can help to reduce costs for sellers and offer consumers a lower price alternative to name brands. The last one is the supply chain management and bargaining power. Yeah, so that is the one mainly used to keep prices low for sellers and consumers.
So like I said, we're not retail experts, but we did do some research on the everyday low price, and looks like they have a number of programs in place to ensure that margin is steady. And then these things are often easier said than done. Back to the private label. Yes, a lot of Costco had private label too, right? They've being very successful at it. I think one of the tricks when you do the type of strategy is you may end up pissing off your suppliers, the brand name P&G and Johnson and Johnson of the world, right? So I think Walmart must be very tactical about this. They can do this house brand, their own brand, to compete with the customer. At the same time, they still maintain the customer relations. I don't know how they do that, but the outcome is indeed very convincing that they're able to maintain a very steady ROIC and margin. Okay. Any other question? Would you mind to share one of the Magnificent 7 stocks on a screener list? Yeah, the rest are not performing badly over that recent 1 year. So I think one question is about talk about one of the Mag 7 stocks on the screen, and then the rest of the Mag 7 stock price are not. Okay. I think we have 2 or 1. So we have Alphabet, and we have anything else? So Garrick also with me. I thought we had Amazon. I guess at one point it dropped out. It did come up in 1 or 2 steps of the screen. So yeah, Google look like they have pretty high ROIC, about 24%, and also very low volatility since 2004, and of course the net cash. So that's the reason it pops up. Any view on that, Garrick?
Yeah, Google. The problem is for Google is antitrust, and it could possibly be replaced by AI. So it's the last of our pick in Magnificent 7. Although the valuation is attractive.
Is attractive, of course. Yes. So Google, as you know, it's actually. So I was thinking on this when I see this name pops up in the stock. I was also very surprised. I think their steady ROIC has to do with their dominant position in search, in the search business, almost a monopoly position in that business. But this is where the fundamental research is coming. Remember I said, you want to be in an industry that not faced with so many changes, right? You could have a search business by Google, very steady, very, very predictable. But then suddenly the AI comes in, it's going to disrupt all the future. And that's exactly what's happening with Google, where you can, I think in terms of AI, it's going to change how people search and use information. going forward. And Garrick and I have a lot of discussion on this. At one point, I think there's even possibility that whole search business could be destroyed because everything's moving onto an AI agent platform. So when you want to search for a, say, Italian restaurant, you want a best Italian restaurant within 5 miles from you, you're not really searching. You try to solve a problem. Well, the problem you want to solve may be that you have a client in town, you want to impress him, you don't want to go too far, but you know he likes Italian food, and where should you go? So in the AI world, you can ask Cherie or Apple Intelligence or whoever, Gemini, that's Google, about this question. You don't need to search. You just ask that question. I have this situation. How can you help? So just imagine that's going to disrupt the original traditional search business. And the other thing, as Garrick highlighted, think about what is the biggest risk to the whole sector is the antitrust. And Google actually now faces the biggest antitrust. Even talks about breaking up, right?
Yeah.
Yeah.
Not likely, but
not likely. It's going to take a very long time. Of course, these things will drag on, but it's overhang on the stock. And 6 of the Magnificent 7, including Google, are in some kind of antitrust investigation or proceeding already. That's how extreme it is for the AI regulatory scrutiny. You check the performance of Google. Google actually recovered quite a bit recently. Recently, there seemed to be a trend of Google catching up with the rest of the Magnificent 7, because that's also a theme to me in Magnificent 7, that the laggards are catching up, whereas the leaders are slowing down. So Nvidia clearly is getting to a range-bound situation where difficult to break the 120 or 130 price ceiling. Again, if you have any more questions, please use the window to type the questions. We will answer them in order they come. Okay, if no more questions, let's end here. We will circulate the PPT for your reference, as well as making the replay of this webcast online for your consumption, for your client's consumption. Thank you so much. Have a good night.